Welcome to our session this morning, in which we will explore the effect of the pandemic on real estate values across the various sectors. This session is hosted by PAM Insight with support from IPSX, the new stock exchange for real estate. I'm Alex Newlove. I'm the editor of The WealthNet, a news service which is owned by PAM Insight and widely read by those working in the private banking and wealth management industries. I'm joined today by four very knowledgeable panelists, one of whom is having slight technical difficulties at the moment. So Anna, we might leave your introductions till last. This is an interactive session, so please do submit your questions as they occur to you. You should see a Q&A icon at the bottom of the screen to do so. Firstly, I'll hand over to our panelists to briefly introduce themselves. Farhad, would you be able to kick off, please?
Yeah, sure, Alex. Good morning, everybody. My name is Fahad Kamal. I'm the Chief Investment Officer for Kleinwort Hambros. We are a private bank wholly owned by the Société Générale Group of France. And I am here actually as a generalist investor in how we view real estate. And actually, I'm hopefully here to learn as much about the industry from our specialist panel.
Great, thanks Farhad. James?
Good morning, everyone. My name is James McTighe. I'm a head of commercial valuation in London for Jones Lang LaSalle. My remit basically is running a team of valuers who concentrate broadly on the main commercial food groups of offices, retail and industrial sectors.
Great, and Roger?
Good morning, everyone. I'm Roger Clark. I'm head of capital markets at IPSX, which, as Alex said, is a new regulated stock exchange dedicated purely to listing real estate assets.
Great, thanks Roger. And then we also have Anna Lazenbury on the call, who's just trying to get her audio sorted. She is the head of property at the multifamily office Stonehage Fleming. We know how difficult it is to carve out the time for these events, so huge thanks to all our attendees and especially our panelists. So if we could bring up our first poll question to start with. We wanted to kick off the session by getting an idea of how our audience views the sort of overarching question that we've set ourselves today. And we may repeat this exercise again at the end. So could we just bring up the first poll, please? Great. So our overarching essay question for the day is, will the value of real estate change post-COVID? So yes, some or all real estate sectors will be permanently affected. No, within 2 years, the way we live and work will be more or less the same as pre-pandemic, or unsure. Please give your answers now, everybody. Okay, wow, that's really interesting. So the vast majority of us seem to think that, you know, this is very much the new normal, and people don't see life reverting to sort of pre-pandemic times. That's interesting. So let's set the scene and take a look at what has happened so far this year by asking the panel how sort of demand for various property sectors has changed during 2020. James, perhaps you could cover this from a commercial point of view to start with.
Yes, sure. I think I'll concentrate broadly on sort of industrial retail offices, if that makes sense, just to stick to the main groups. I mean, starting with industrial, I would say broadly, particularly the logistics sector has, you know, already had very strong existing demand before the pandemic, and I think that's probably, we've seen that strengthen over time, over the pandemic. We've seen, you know, demand for additional storage from, you know, the supermarket chains. NHS took a huge amount of short-term storage for PPE, etc., and so on. And then also, I think just looking at the sort of wider infrastructure, we see the need to probably shorten the supply chain. You know, obviously a huge amount of a huge amount of goods come in on ships and planes and so forth into the UK. We're big importers, and I think actually, whilst we probably will still continue to import a lot of our goods, I think the ability to hold more here will be more important. I mean, we've all seen the online retailers running out of stock over COVID. Obviously, other trends that are going on, which we've seen intensify. Supermarkets demand for online delivery has gone from 7 to 16%. I think that will keep going. Similarly, increase for online shopping, and so I think in summary, sort of the key logistics centres will benefit, and also locations suitable for last mile logistics will also benefit, which is the near to major urban hubs, and to allow Amazon and so forth to do those short delivery timetables. I think we'll also see some retail warehousing repurposed into industrial or quasi-industrial. The growth of dark kitchens, which are used to by the likes of Just Eat and Deliveroo, etc.
Hi, can you hear me now?
Yes, wonderful. Welcome, Anna.
Hi, we got there.
Excellent.
Hi.
James, did you have anything else to add?
I was going to touch a little bit on perhaps retail and offices. I'll perhaps just keep it short, but I think obviously retail was already going through a structural change way before COVID struck, and obviously that's just been a massive accelerator in the retail sector. I don't think it's a total issue across all the sector, and it's very location and sector specific, but certainly more problems in the secondary markets. But things like obviously supermarkets have remained strong, and also we've seen a rise in the convenience sector as well. And obviously the online piece that I mentioned in the industrial logistics is also strengthened. I think just picking the offices are the more difficult sector. There was perhaps a trend to hot desking and working from home more. Anyway, pre-COVID, I think obviously again an accelerator of that trend, but it's not the solution entirely for offices. People do need to work in offices, work together physically rather than just virtually. Although I think we will see more trend to some more flexible working, both in the way employees work and also in the way occupiers physically lease and occupy office real estate, in the sense that we'll see more of a core and flex approach, and perhaps more of a move from it's been discussed from CBDs, where the transport, particularly in places like London, is difficult at the moment without a vaccine, and whether we'll have more of a hub and spoke model with offices being dispersed around central CBDs more.
Okay, brilliant. Thanks, James. Anna, perhaps you could now pick up on the residential point. Thanks very much for your perseverance in joining us. What have you seen so far in terms of demand in 2020 during the pandemic period, and how does it compare to previous years?
Sure. Morning, everybody. It's certainly been quite an extraordinary year. We started the year with a really kind of positive feeling. The general elections were behind us, and some people refer to it as the Boris bounce. It was, a great start to the year, and then who could have ever thought that 3 months later we'd all be in a physical lockdown? And I think, unlike potential downturns in the past where they've been more gradual or there's been less liquidity with banks, this was almost overnight physically. Obviously, that's very limiting with property. You can't actually go in and show any properties or see any properties for several months. I think that some of the transactions that were tied up before still went through. I know a number of people had ones that fell away. We were quite lucky. We had several that did continue. Since the reopening of the markets, there's been a real hive of activity, and I suppose what will be interesting to see in how it plays out is whether that's almost kind of pent up demand, or whether that is demand that will continue. And I think there are all sorts of obviously changing elements that continue to affect this daily and will for the rest of the year at the beginning of next year. Obviously, we've gone into a kind of restricted second almost lockdown. We've got the US elections, there's Brexit, you know, who knows when a vaccine will be found. I think that's also quite prominent in the sense that there's a lot of people that haven't come to London in particular this summer who often would as purchasers because simply the travel has just been too difficult. I think, as James said, you know, it's changing at the moment the way we live and the way we work. And I think it will be interesting to see how that pans out, if that is more of a temporary measure or if CBDs change and if people end up spending maybe 2 days in the office and 3 days at home. I think the focus of one's home has almost never been greater. And I think that there is quite a drive on the family. Outside space is unbelievably sought after at the moment. And I think there's been quite a shift in what one would consider to be a premium. So would you still consider a 2-bed flat near the station to be such a premium if you're traveling less, for example? So it's all quite moving.
I think we've just had a question in, Anna, actually, from Fiona. Thanks, Fiona. And she said, do you think London will remain a destination of choice for families, particularly those who immigrate? Have you seen people wanting to live in more rural settings / out of the city?
So in terms of the country interest, it's certainly very active at the moment. It's a market that hasn't always had the easiest time for the past at least decade. And I mean, if you speak to Knight Frank or Savills, their country department's absolutely booming at the moment. I would say that that's twofold. You have perhaps people who are moving further out, and that might still be London. So, for example, you have suburban offices that are much more busy. So you have your Wimbledon office is more busy than it usually would be in years previous. Your Wandsworth office might be as well. And then you have obviously further out of London where families are moving to, where there is a lot of demand. But I think a lot of that is also second home demand. So I don't think everyone is upping sticks and leaving London. But I think that there is, you know, if someone can have a family and have a larger garden and they don't have to be in the office 5 days a week, that's clearly attractive. But I think London will always remain a destination for so many reasons. You know, the arts, the culture, the political stability, the education system, our infrastructure. I think that, you know, also markets are always cyclical.
Roger, just picking up on some of the trends that James and Anna have touched on so far, can you sort of do a little bit of crystal ball gazing and maybe talk a bit about how you think these will play out in the next sort of 18 months? Are there any areas of the UK that you think will be the winners and losers?
Yeah, I think it's interesting because I think picking up on things both James and Anna have said, there's a short term and there's a long term here. I think in the short term, as James mentioned, travel is, it's funny when you think about office use and which offices are relatively more or less investable today. Actually, it's not so much the office itself. Clearly, 60-story high-rise city towers are not much fun to work in at the moment, but on the whole, because of the waiting for the lifts and just the logistics to your desk. But more normally, I think what people are focusing on is how do I get there? So, as we've all touched on already, the long train journey into London is a lot less attractive than it used to be. I think offices which are near mainline terminals, so that you don't need to use the tube, are better than ones where you need to make 2 or 3 changes. But I think the real winners in terms of location will be cities outside London. I think take Birmingham, for example. That's already overtaken Manchester in terms of its retention rate of graduates. There are 5 universities in Birmingham, and it has more graduates stay in Birmingham than any other city in Europe. And so it's a youthful population which is growing, and these people just won't feel that they need to come to London anymore. And I think cities like Birmingham and Leeds, Liverpool, are going to be long-term beneficiaries at the expense of London. But I also agree with what Anna was just saying. You know, one day it feels like we're in the eye of a storm at the moment. It feels like everything is taking longer than we hope. A vaccine was going to be ready in 3 months. It may not be now ready for another 6 or 9 months, but there'll be a vaccine one day. And then the thing that for centuries has driven people to live in cities will come back. Anna was just referring to it, the cultural attractions, the ability to mix with people. Cities are growing for a reason, and that's not going to change in the long run.
Mm-hmm.
Yeah,
Right.
Roger, I agree with you. And I also think that, you know, whilst there is perhaps a more work-life balance to be had also with spending perhaps some days at home, I don't think that the office is dead. I think people enjoy the interaction, projects, working together. So I'm not convinced people actually would want to be working 5 days from home all the time.
Cool, thanks everyone. We've had a couple more questions come in. So Kevin's asked, as an investor in real estate, does the panel think the regions offer better value than London? Roger, I think you sort of addressed this with a resounding yes. James, Anna, Fahad, any thoughts?
I think in the short term, it's easier to. I think it's easy to understand that, you know, for the reasons that Roger was talking about, it's easy to understand the ability for some of the regional, particularly like the office sectors to address the COVID problem a little bit easier because of the transport thing. The transport is a big issue in London, and the ability for people to drive to work and park their car outside their office is something that I think is very appealing and being considered. And I think also, I mean, there's two, I think, counter arguments. Obviously, the long train journey into London is probably something that people are starting to get concerned about, like Roger was saying. But I suppose the counter argument to that is that if people don't have to come in so much, in terms of it's a two to 3 days a week, like Anna was saying, then the prospect of actually living further away and coming in less is, you know, so you do actually increase your draw of some of the CBDs. So you know, in terms of the geographical pull. So there are I think there are factors pulling both ways for London and for the regions.
And I think also that it depends who you're looking at, you know, capturing as a market. I think that focus, and I agree with you entirely, James, is, you know, if where one would be working. But if we look at who also wants pied-à-terres or apartments in London where they might spend several, you know, months a year, those decisions are not probably driven always by where one might be working. It will be more about a lifestyle decision. And in that way, I think London will always continue to dominate.
Thanks.
So just the only thing I would add to all of this is that obviously I think that, you know, we are thinking about this very much at a personal level as well, and in terms of micro decisions that people make, families make, even groups of people, etc. You know, but how we sort of at Kleinwort Hambros, you know, view real estate is somewhat different. Obviously, we're an institutional investor. Our clients come to us usually having already, you know, 1, 2, 3 houses that they've already got, and their sort of personal real estate decisions are essentially done. investments that we manage on their behalf essentially are real estate as an asset class versus other asset classes, and what is the relative attractiveness of the entire asset class as a whole. And we model that question quite, quite sort of intensely within our investment process. I mean, and, simply put, what does that mean? Which is that we are trying to assess and gauge what the expected returns over the next 5 years would be from the real estate investment trust sector, for example, a publicly listed avenue for which we can access real estate returns, and see whether that is more or less attractive than placing those investments in the wider equity markets, in the bond markets, in the commodity markets, etc. So that's sort of where we're looking at it, sort of at a higher level. And it's funny, and sort of right now, given the fact that we've had quite a valuation compression within the real estate investment trust sector as a whole, there are definitely some bargains available. And actually, the expected returns on real estate once again at the publicly listed level are higher than some of the other competing asset classes. So for example, real estate is about, give or take by our modeling, about 5% expected returns annually over the next 5 years, versus equities at about 4.5%. The problem, of course, is that it's not as simple as just that. Number one, this is an estimate. Who knows what realized returns will be? Two, this extra expected return comes with a huge amount of volatility, much more so than that exists within the other asset classes. So you've got to take that potential expected reward along with some of the risk, and that's sort of the kind of the process that we start to employ to when we're thinking about deploying within real estate as a sector as a whole, from the top down.
Great, thanks everybody. So I've got a question in from Mark, and thanks to everybody who's sending them in. We've got some great ones here. So Mark has asked, do you think we will see development of lease to own type programs, particularly in residential?
Sorry, could you just repeat the last bit? I didn't hear you.
Sorry, so Mark's asked, do you think we will see development of lease to own type programs, particularly in residential?
I don't know. It's hard to kind of see what exactly will pan out at the moment. I think that the market is changing and will have to change and will have to adapt. I think going forward, obviously how one owns in London is quite different structurally to how one does often further out in the country. I think it will depend on quite a lot of factors, but I think it's likely, yes.
Okay, great, thank you. Right, it might be time for our next poll, I think. So Catherine, could you bring that up, please? So a lot of uncertainty, which I suppose is not surprising. Quite a few people keeping their powder dry, and around a fifth who plan to increase their exposure. Thanks, everybody. So I just want to come on to this fund gating issue for a moment, just because obviously this has been a big one for people investing in property during the pandemic. So in past crises, we've obviously seen open-ended property funds gate over liquidity concerns as investors sort of panicked and looked to pull out their money. With the coronavirus crisis, the gatings we've seen have been a bit different in that they related to the inability to kind of value the underlying asset rather than just generalized panic. So the FCA then came out and said that they plan to extend the redemption period on these open-ended funds to 6 months. So I'm just curious as to how the panel thinks this will affect the property fund market, and how might investors look to access real estate now that funds are looking more sort of challenging and illiquid? Maybe Roger, you could start us off.
Yeah, I mean, it's gonna have a huge effect. I mean, the reason these funds exist is to the point that Fahad was making earlier on, that listed real estate REITs exhibit a degree of volatility, and of course they do, because they're listed on the stock market, so they have beta. They're not real estate. They're equities that are invested in the real estate sector. So there's a big correlation. In fact, take a British Land or Land Securities, the correlation with the all share is perfect. They have a beta of 1. So they're not real estate. You get real estate returns by investing into an open-ended fund. You lose the volatility because there's no daily pricing. There's supposed to be daily liquidity, but of course there is no daily pricing of the underlying assets. So when you want to get your money out on a daily basis, you need the manager to redeem it for you. And as you allude to, Alex, that hasn't worked. It's repeatedly failed to work. It's a model which is not fit for purpose. The FCA are, with all due respect to them, tinkering with this idea of a 180-day redemption window. Frankly, the IPF would tell you that selling a building in London on average takes 189 days. So perhaps 180 days doesn't actually solve the problem anyway. But it's a bigger point than that for real estate, because of course the daily UCITS funds allowed a certain type of investor that 180-day redemption windows now don't. So unfortunately, commercial real estate is becoming uninvestable for most retail investors. By retail, I mean anybody who can't afford to buy a building for £100 million. It's making real estate uninvestable, either because you can't go into these open-ended funds, or you can't bear the volatility of the wider equity market. And of course, that's really bad news for what is actually the biggest asset class in this country. It may get overtaken by gilts soon, but at the moment, it's the biggest asset class in the country. So something structurally needs to change, and something needs to be done to provide people real estate returns, but with liquidity and transparency.
Mm-hmm. Fahad, how are you looking at these funds at the moment? What's your thinking around them?
No, so sort of echoing exactly what Roger said. I mean, the basic conundrum is that investors like us seek daily liquidity in what is inherently an illiquid asset. Mm-hmm. That's a circle that cannot be squared. The easiest fit for that impossible conundrum is the REIT index, but as Roger mentioned, it is equity, right? And it has a very high beta to the equity market, and you're basically effectively taking on the same level of volatility, actually a greater degree of volatility and a greater degree of drawdown. So which is the peak to trough loss. But what is interesting is that even within the REIT sector, which is what we would basically look at in order to make real estate investments, this year it has resembled the wider equity market in a lot of ways, and there's been some really big winners and some big losers. So, for example, if you take some of the biggest REITs on the US market, because everybody knows about it and it's big and it's wide. But if you take Simon Property Group, for example, tens of billions, it's its market value, and basically what it owns is shopping malls and outlet malls, Bicester Village type things, and that is down about 30 or so %. Don't quote me on the exact number, but it's down big over maybe even actually I think down 50% over the course of the year. For obvious reasons, as James and Anna and others have mentioned, we are retailing less in physical proximity and retailing more by Amazon, etc. And then that sort of leads you to the other part of the REIT market. You take a company like Equinix, which basically owns data centers, cloud computing warehouses, and that kind of thing, and that's up 30% on the year. So once again, reflecting what really is happening in society, in the equity markets, etc., where you've got a huge divergence underlying this enormous REIT sector. The winners seem to be connected to the way we have changed over the course of this year in terms of how we shop, things that all of these Zoom calls that we're doing at home, and the things that we used to do, such as going to Bicester Village, is obviously much curtailed, and all of that is reflected. So the point, I guess, really in the end is that while real estate continues to be a very important asset class, we have to be, like equities, very differentiated in exactly what we're holding, as well as making sure that we have assets, we hold assets that we're able to exit out of quite quickly. Smaller property companies that were gated after Brexit, etc., are not ideal solutions for investors who are like us, which are obsessed with the ability to be able to exit when we wish.
Thanks, Fahad. Right, I'll go back to our attendee questions for a moment. So James, Kevin has asked, how can valuation reporting help investors when thinking about future value?
Yes, I mean, I think that's something we've been looking at for a while in terms of trying to look at future value in terms of. And I suppose there's a couple of things. The valuation industry is always slightly criticised for looking backwards because it looks at obviously recent past transactions to form a view on what things are currently worth today. So I suppose there's two things we've been looking at more, which is more move towards, particularly in the commercial real estate market, towards discounted cash flow approach to valuation. So we're looking forward into our forecasts and how we think a property will perform going forwards, and that's becoming particularly more relevant as we see particularly commercial real estate move from really something with bond-like characteristics where you let it to a tenant for 25 years on a full repairing lease and collected the rent until the lease ended. Now it's a far more active business, generally with shorter leases and more moving parts, and obviously that type of approach plays more of a business valuation, plays more into a sort of discounted cash flow analysis rather than the traditional valuation analysis. The other thing we've been looking at more is more around sustainable value, and we don't mean not ESG type thing, but actually long-term value. And so, what is the long-term stable trend in something, and then we can look at whether things are above or below that trend, which gives you an indicator of how over or undervalued assets are to trend. So I think that's easy to say and very hard to do. I've been working with Oxford, Brookes and Cambridge University on it for some time, and Reading University, and it's actually it is actually harder to do properly than you would realise. But I think things like that will help future indicators.
Okay, cool. And then following on from that, Roger, how can IPSX help investors when trying to understand values?
Well, IPSX is a stock exchange for property assets. We're launching our first one next week. It is a single building. It's worth £180 million. By shares in it. You can buy shares in it, which can go into SIPs and ISAs. There'll be liquidity provided by market makers, quoting firm two-way prices. It is literally a way of buying shares in something that will trade like a building. It won't have, because we're a dedicated stock exchange, the beta that we were talking about that Fahad mentioned earlier on won't be there. Tesla's share price will not affect things that happen on our market. So that's, for a start, that's a huge help, because for the first time ever now, what is going to be available is a securitized, regulated, liquid way to own a share of a building, and you can choose which buildings. Equally, some of the questions that have been coming in have been asking about lease lengths, and of course lease lengths may change. James has alluded to this. The key takeaway is that real estate is becoming ever more and more operational. The days when you could buy something, let it on a 25-year lease and go and play golf while you collected the rent. So yeah, people who used to buy buildings, now they actually need to be managed by professionals who can talk to 53 tenants every week. So you want to provide people the way of accessing returns from real estate, but in transparent liquid instruments, daily pricing, daily liquidity, genuine daily liquidity. And all of this will mean that we're going to see the value of a building every day, because of course, we talked about it earlier on. We alluded to the fact that unlisted real estate is less volatile than listed real estate. It is, of course, very naive to think that the value of real estate doesn't change on a daily basis. It's an asset that produces cash flows. And like any set of cash flows, they can be discounted at a different rate on any daily basis. So we're going to provide transparency at the asset level, which we've never had before. And it can replace, it can become a proxy for fixed income. It can become a proxy for owning real estate and all of that daily liquidity. So that's how IPSX will help.
Great. And I think that a question that Justin has submitted probably leads on nicely from that. So he's asked, do the panel think that high net worth clients and families who manage their own property will dispose of real estate assets in favour of indirect real estate investment or alternative assets? Fahad, is that something that your clients have spoken to you about at all? What are you sort of hearing there?
In my career so far with private clients, I found that, you know, that they tend to be very lucid and very analytical when it comes to equities, fixed income, when it comes to, you know, investment grade bonds, et cetera, et cetera. There's two asset classes in which I find in general where the lucidity and rationale tends to grow up quite a bit. One of them is real estate and the other one is gold. Everybody has a very emotive connection, or appears most people have an emotive connection to those two asset classes, particularly real estate, because obviously, you know, it's something we all physically, you know, you don't physically live inside of an Apple share, right? But you do have some sense of real estate, etc., and you have a much more emotive connection with it. And it tends to be a pretty stable long-term allocation for most private clients that tends to move around relatively little as compared to the other asset classes. So the answer to the question is, I don't expect people to start dumping real estate assets. In fact, if anything, what we have noticed as a result of the last few months of volatility is a lot of questions regarding where's the value, where can we buy in now? Is this a good time for us to deploy capital towards, you know, to the kind of market that Anna is talking about, you know, residential, you know, are there flats in London that are suddenly great value, and that kind of thing.
Mm-hmm. Great, thanks.
I think also,
yeah.
I would say, I mean, that's tying into exactly what Farhad said. It depends what your driver is behind, you know, why one's purchasing. And I agree with you entirely. It is often quite an emotive investment. I think it's one that also tends to be popular, but far more now for the long term than perhaps it has been in the past. I think the way in which people buy and how often they buy has changed quite a lot in the past, say, decade, especially with, you know, the level of things like stamp duty.
Mm-hmm. So there's obviously been a remarkable level of government intervention right across the economy, but for the purposes of this discussion, in the relationship between landlords and tenants, with, you know, landlords essentially being told they have to treat their tenants with a lot of leniency during the pandemic. I'm just curious as to what, you know, you think this means going forward, and James and Anna, maybe you could handle this on a commercial and residential basis respectively.
Sure. I think you're right. The government have got very involved and they've tried to protect tenants basically against eviction. And whilst I can understand the thinking behind that, I think that it's put landlords in quite a tricky position. Over the period of lockdown, basically the notice period that one is required to give has gradually increased, and it now stands on an AST tenancy, which is the majority of tenancies across the UK, will be a 6-month notice. And that's quite difficult for a landlord because that applies even if someone is in rent arrears or actually has ceased to pay rent. And that is on top of multiple changes over the past few years where I would say tenancy costs have been passed to the landlord, including referencing tenants, inventory costs, admin charges. So I think it puts landlords in quite a tricky position. I can understand that the idea being they don't want tenants to obviously be evicted across winter. But I think that does make it quite difficult if obviously you have a cash flow and you're dependent on rent coming in. That rent isn't coming in and you can't really do anything about it for the moment. And I suppose I was speaking to an agent about it yesterday. What will the outcome then be? Will it mean that there's then a huge backdate of court hearings, and how will that then play out?
And James, what are you seeing on the commercial side?
I think it's similar, really. I mean, I think obviously the commercial landlord is and real estate investors are, or in my view, always a fairly soft target for the government, I'm afraid. And you know that sort of we've seen that sort of you know, the intervention that we've seen, you know, with landlords prevented from getting possession, like Anna says, you know, can frustrate obviously strategies, management issues, and things that landlords need to do in terms of everyday management of real estate. You know, they've also got their own obligations, which somehow seem to go ignored. You know, they've either got to provide returns to their investors. Most of these, most people are leveraged, so they've got banks to deal with in terms of ICR breaches and the ability to meet these obligations as well. And it slightly ties their hands in that respect. I think we've also seen a little bit of unevenness with some of the legislation in terms of around empty rates as well, where, you know, landlords are having to pay empty rates, whereas tenants had some exemptions put in through the pandemic, which you know, makes the playing field more, you know, further uneven. Obviously, that burden changed in terms of the empty rates liabilities some years ago for landlords, and it has had and you know, has a continuing impact. And I suppose just dragging something else in that's connected but not directly related. Obviously, the CVA process that we've seen used time and time again over, particularly over this pandemic. I mean, at last count, we keep losing count of retailers going through CVA, but I think at last count we've seen 41 or something retailers go through CVAs in you know, through the pandemic. You know, allows tenants to basically tear up contracts, you know, which whilst is required for them to survive, can put landlords in a very difficult position in the sense that they've switched from you know, a certain income stream to one where they're still tied into the lease, but they have a variable income stream, lower base rent and turnover, which obviously, you know, hinders their own you know, their own ability to operate.
What do you think about that, Roger? Like, has the government sort of set a bit of a dangerous precedent in terms of the level of intervention and how real estate will be perceived as much more risky now, potentially?
Yeah, I think that is, or at least at times during lockdown, that has been a potential danger. I've heard some CIOs of private banks say, yeah, I wouldn't touch commercial real estate because people don't pay rent. And I guess what it means is that more than ever, today more than ever, what you need to do if you're about to invest into any real estate investment of any sort is you need to analyze the people who are paying the rent. You need to analyze the covenant strength. You need to do some proper work on how robust those income streams will be, because actually it's not been the case at all during lockdown that nobody has paid rent. What has perhaps slightly counterintuitively been the case is that most SMEs have paid their rent fully, and it's usually listed tenants, listed retailers, listed tenants who haven't paid rent because they've felt as if they shouldn't, because their investors expect them to cut costs, and the government made rental payments optional. So I think it's about, and probably this is again just emphasising something that was always the case anyway, but it's about doing your homework on how secure the income streams will be.
Oh.
Just on that, I just wanted to add sort of one little bit, which is that, you know, to that exact point, you know, traditionally we always used to view the you know, the reliability of the cash flow and the income stream. One way of doing that, one proxy, was the length of the lease, right? was that the longer the lease was on a particular property, whatever from the tenant, the better it was considered. But that's turned out to be quite a shibboleth in this recent environment. And so what do we use as the new proxy to gauge reliability of future income streams? Well, we're looking for it, and hopefully we'll find another one soon. But clearly, the underlying sector of the business is one, but the traditional one that we used to use is less reliable.
Well, Fahad, on that, it's interesting to hear you say that. But at IPSX, one of the things we're going to do is provide quantitative income analytics on the assets that list on our exchange. So effectively, they will have a synthetic bond rating, and it's forward-looking, and it's about probability weighting on the security of the tenant. Not just whether they'll pay the rent, but you make a good point. Travelodge, Secure Income REIT, which have Travelodge as a tenant, have the longest weighted average lease lengths in the listed sector. But if the tenants don't pay, they don't pay. It doesn't matter how long the lease is.
Excellent. You guys can talk afterwards. Are these?
Well, just on the point that Roger made. Sorry, but I agree as well with what he was saying about the smaller businesses tend to have paid more as well because they've got less negotiating power. They've got to pay. But where you've got these huge sort of multinational companies with lots and lots of properties, they've actually got a lot. Those tenants have a lot more power than the landlords do, and they're a way to get away with paying the rent at a time like this.
Mm-hmm. We've had a question in from Paul, and Paul has asked, are the costs of actively and professionally managing properties likely to be recovered in addition to rents? Or is the real estate market becoming that competitive that these costs will be absorbed by landlords, thus resulting in lower property value growth?
I think on the residential front, I would say that relates back to what I had said earlier, that there has been a bit of a shift in what costs were generally on the residential side. Clearly, I can only speak for Resi, are borne by the tenant and what are borne by the landlord. And I think if you're looking at, a tenancy where maybe you're getting £1,500, £2,000 a month in rent, or slightly more, and then every time you have a tenant change, you're doing referencing costs, you're covering all the costs of the check-in and the checkout, you're covering the agent's admin fees. I think if you have tenant changes reasonably regularly, that will start to bite into your profits.
I think on the commercial side, it's a little bit sector by sector, but I think this sort of full FRI sort of lease arrangement where the tenant pays everything is probably becoming rarer and rarer, and particularly in sort of things like shopping centres, etc. The NOI, not the net operating income, is becoming increasingly variable, tenant by tenant, and we're seeing tenants being more selective in terms of what they pay. So we will only pay so much service charge, or we're not going to pay the service charge, or we're going to do that but pay less rent. And so I think that will, or that we will expect the landlords pick up the rates, and that's sort of more of a flexible approach is going to continue, and actually that's perhaps we've been perhaps slightly an exception in a lot of the world in the UK with that sort of historic lease structure, and many of the European countries have that sort of where landlords absorb more costs. So I can see it happening certainly in the retail market more, and probably the office market, as that becomes more of a sort of flexible offering where occupiers lease space on a more flexible basis, more costs go into the landlord, but equally in that instance the tenant probably pays more rent for the flexibility. So there's a bit of a balance up, but I think like Anna says, some more of the costs are being deferred to the landlords.
Great, thanks, James. Right, it seems these days that any sort of discussion on investing is not complete without at least one mention of sort of sustainability or ESG. So does the panel think that ESG factors are going to become more or less important in future real estate investment decisions? And how might some of these factors affect valuations? James, maybe you could pick up on the commercial to start.
Sure. I mean, I think to answer the question in short, yes, it's becoming far more important. Obviously, we're seeing the government outline net zero carbon commitments for 2050, etc. In fact, occupiers are actually, like ourselves, for instance, we've sort of said we want to be net zero carbon by 2030. So you're seeing industry and government legislative push from that, and I think it has to be right, because if the desire is to reduce carbon emissions and improve sustainability credentials, real estate has to play a part. With having taken, 40%, real estate consumes 40% of global energy and raw resources and produces 25 to 40% of all waste. So it has to be factored in. We've not seen it factored into valuations so much yet in terms of, will people pay more for a green building? But I think it's starting to come. And what we've actually just done a study on central London office real estate. And the research that finds is actually buildings with high sustainability credentials lease faster, achieve higher rents, and are actually have lower maintenance costs through life cycle, but do cost a little bit more on the upfront.
Mm-hmm.
I would agree with you, James. I think it's quite similar on the resi front. I think there is a push for it to happen, and I think you can see it in more and more developments. I think there are more electric charging points, there are solar panels, there are different things that people are trying to do to make make the changes. But I think one big point, as James touched on, is that the costs up front do tend to be higher. So if it's a developer looking for quite a substantial return on a building, it might be that the cost of putting in certain changes reduces their profit. So I think that's always going to probably be kind of one of their questions. But I think that on the valuation side, I think it was starting to see it, but I think there's still quite a long way to go.
Great, thank you. So I know that we're nearly at the end of our time. So Catherine, I might get you to bring up our exit poll before people have to sort of start dropping out for other commitments. In the meantime, Roger, maybe you could address a question that was sent in by Toby, where he's asked, do you have a view on how this COVID may influence large infrastructure projects such as Crossrail and HS2?
That's an interesting question, isn't it? Yeah, I think obviously I want to steer clear of politics, but when I think of those two projects, I think HS2 will go ahead and Crossrail might not. The reason I think that, Crossrail obviously is there already. I'm thinking Crossrail 2. The reason I think that is I think that the political push is to invest in the regions at the expense of London. So I think HS2 is an absolute given, because Boris Johnson has promised the red wall that he won't forget them. So we're going to see continued infrastructure investment up north, and probably at the expense of London. I live in Fulham, and I would like to see just a little bit of money given over to reopening Hammersmith Bridge, but it's in London and it probably won't happen.
Mm-hmm. Great, thank you. Okay, can we bring up that poll, please, Catherine? Just the same one that we had at the start. Great, thank you. So we're going to do an exit poll, see if anybody's changed their mind during our hour-long discussion. So same question as at the start. It should be up on your screen now. We've had a few people drop, but not too many for their 10 o'clock meetings, presumably. Okay, I think that should be enough time. So we've had a slight uptick in the number of people who believe that, yes, real estate values will indeed change post-COVID. So thank you very much to all our attendees. There were some fantastic questions coming in, and if I haven't got to you, it's only because I hopefully think that the discussion covered it naturally anyway. And a huge thanks to all of our panel. We obviously have a lot of expertise and we've covered a huge amount of ground in our 1 hour session. So thank you all very much and have lovely days.